That is
Okay. Yeah, now it says our meeting is being recorded. All right. So it is 5:01. I believe we can start. Usually when we start an event like this, we might want to begin with a prayer, but I'm going to assume that we all prayed this morning, and we are then going to continue with our program today. Bumele Bontate, good afternoon, perhaps evening. It is 5 p.m. and this is our webinar. The webinar is on the global impact on long-term investing. The idea of this webinar, I'll let Relebohile to speak to that. This is an annual event that really brings us closer to our members as the Lesotho Employers Umbrella Provident Fund. And then without wasting any more time, Mayor Relebohile Seshemane, who is the head of Employee Benefits at Alliance, please give us the purpose of this event, why it is important to speak directly, as you will be now, to the members of the fund. And before I let you go, um, why should we be investing for the long term, especially if one looks to retire comfortably? Thank you. Over to you.
Thank you very much, Ndeteswedi. Greetings to you all, ladies and gentlemen, and thank you very much for making time to be with us this cold June evening. As Ndeteswedi has introduced, my name is Relebohile Seshemane. Currently working with Alliance Insurance. I work on the employee benefit space. I also work within the life insurance space. Have been in the pension fund sector for quite a long time, over 10 years. And I think pension funds are some of the long-term vehicles that invest in the market. So this topic is quite close to our hearts as the pension fund industry within Lesotho. Obviously, the long-term investments can vary, but I think specifically for retirement benefits, the impact that this global tensions cause on our investments is quite close to our hearts. As we know, with the current geopolitical tensions that we are living in, this many conflicts, they have far-reaching consequences, which might extend even beyond just the battlefields which they operate on or which they are in, but they also influence the financial markets and hence will then influence where our money is placed. And I think these factors, they directly affect us as individuals, as members of a pension funds, as people who have money in long-term investments. This geopolitical tensions, they affect us directly. And I think we as long-term investors need to have an appreciation of what this means, because as much as we are happy when we see positive returns, we also need to understand what negative returns might mean and what might cause such things, and whether actually do these global wars cause negative returns or is it an opportunity? Should we be scared? How should we react when these things happen in the markets? I think generally that's the whole intention, for us to be educated, to get insights from experts. I'm not an expert in investing, but I think today the idea was that we bring together people who are specialists in this area, people who have an experience of maybe the previous geopolitical tensions that have occurred prior to the ones that we are in, and also to get an understanding of the current ones that we are in, what kind of impact do they have? And previously, the ones that have happened before, how did we get out of them? What did it mean for my pension fund? What did it mean for my long-term investment, which I've placed with an asset manager or with somebody who's assisting me to invest that money? So basically, that is at the core of why we are here today. It's information sharing, it's knowledge, it's understanding, it's appreciation also of what is happening around us, to understand also that the things that are happening somewhere overseas, how do they impact my money, how do they impact my fund, how do they impact my pocket, and what does it mean for my future, what does it mean for the
Sesh, we are losing you there, or is it just me? Sesh, we lost you for a bit.
How do I adjust on that? Do I have to adjust or do I not?
Mhm.
Oh, okay. My apologies. Probably it's my network, but yeah, I
You're
think I had
clearer now. Yeah.
already summarized. All right. Thank you very much.
Okay. Thank you, Ms. Seshemane. So you have laid out the purpose of our event today. And before I continue, I'd like to, of course, now that you have given us at least the go ahead, for us then to see who will be speaking to us today. My name is Seodi Tseua. I look after the investments, particularly for this meeting. We look after the investments that make up the provident funds. And with me, we also have Mema Khotso, who works closely with Seshemane. And I would like, at this juncture, before I continue, to have Mentetwa, if possible, for you to come in and at least help us sort out link issues. Looks like everyone is using Marc's link. If you may, please.
Okay. We have a link that was shared with you. I see that some people shared the panelist link. So I'm just trying to get everyone to join in as the panelist. Sorry, as the attendees who are now using the panelist link. So please just accept that notification when you get it. Thank you.
All right.
All right. Thank you, Mayor. Please look out for a link that will perhaps arrive in your emails. Click on that so that the link then speaks directly to you, so that we don't find ourselves capturing Marc's link in this case. We have in our midst our partners, if you will, in provident funds. I think it's about time that we brought in the experts to speak to you. As Sesh pointed out, that it's important to bring everything together, to have someone unpack really the impacts of these global events and how it will eventually, if it will, affect or impact your own investment. We are joined on the line from Investec Wealth Management. We have Marc Fellner and Riaan Wagner. Hello. We will very shortly also be displaying their bios on the screen. We also have from STANLIB Lesotho, Date Bokang Mokoma. I think you guys see him. And also we have a professional in the investment space, Lerato Sekantsi. So these are our panelists and these are our experts that will walk us through, and I hope in a language that we will all be able to absorb and understand the impacts of the global events and how they do impact, even offer, if you will, opportunity for our investments going forward. Marc, I don't know whether you guys have prepared your presentation and whether you'd want to take over at this juncture. All right. I see you are sharing your screen. All right, thank you. Your screen is up. Over to you. Thank you.
Perfect. Thank you very much. I'm glad the screen has shared with you. Yeah, good evening, everybody, and yeah, welcome to this hopefully very informative session. And today, you know, as the team at Alliance have set out, we're trying to kind of unpack global conflict and what that means for your investments. Myself and Riaan are very humbled to be given the opportunity to discuss these matters with you. And as hopefully you all are aware, in alliance with Alliance, we help manage some of the solutions that sit on the platforms. So, you know, putting together a presentation like this as a fund manager is quite tricky because there's so many moving parts. And I think what is really important at the outset is to say that the conflict really is in the Middle East certainly is something that we don't like to see. We don't like to see conflict. There's real human suffering and market disruption that is caused by the events. And it's very important to take a longer term view and look through what's happening and try and navigate the portfolios that we manage on behalf of retirement individuals or participants in these funds. Ultimately, to mitigate some of the risk, but also to provide return. And I think we need to be constructive about the way we approach these conflicts, be practical about the way we approach them, and hopefully try and provide some security and support through a difficult period. So, you know, we don't want to dive into immediate or news flow around the conflict, but certainly it's very important just to understand a little bit of background and just try and frame why the conflict is important to the way that we manage money and how we navigate through these difficult periods. So I don't want to drive into a history lesson about the Middle East or about why the conflict exists. I think we need to just accept that it does. And on the first slide, I'm just trying to show you a little bit about when people talk about the Strait of Hormuz, why it's important, where it sits, and what the relevance is. And on the left-hand side of the slide in front of you, it's a little bit dark in color, but the little blue dots there are effectively vessels trying to make their way through the Strait of Hormuz. The bottleneck is that area where all of the blue kind of disappears, and you can see there's a bit of a void there. And it's important because more than 25% of global oil moves through this channel. And that really is important in the sense that oil greases the industrial revolution or industry, certainly plays a significant part in GDP growth, and if you like, as a tax that everybody pays to participate in that global growth. So higher oil prices certainly have an impact on our daily lives and also the way that we look at our retirement. On the right-hand side, just trying to give you a sense of the movement of ships and when they expected to start flowing again. This data is a little bit out of date, and that it's from the beginning of June. But I think the point is that there is an expectation that ships start to move again, and those ships have started to move subsequently with, if you like, the ceasefire and potential settlement of conflict in the Middle East. But I think we mustn't be too naive to believe that we, at the end of this conflict, potentially there may be some more, and we need to continue positioning for both a positive and a negative outcome. So we think that markets are starting to open up again. We can see it in the US inflation details or forward details, and also we can see it in the oil price. And it feels like we've moved through the precipice and we're in a situation where the conflict potentially is behind us. So let's just talk a little bit about what that conflict meant for oil prices, why it's so important. And what we're showing you here is that bottleneck in that strait. And you can see from basically February into March, as that war started on the 1st of March, the number of ships coming through that strait basically fell off a cliff. And the numbers are starting to shift up again, yes. And the question is, when do we get back to that sort of 1,200 number? And by all accounts, we think it can happen quite quickly, but certainly it's not going to all happen in one day. So the ships are starting to move again, the oil is starting to flow, and certainly we believe that the chance of normalization is improving every day as we see negotiations happen in Switzerland, primarily between Iran and the US, but facilitated by Pakistan and Qatar. I think it's also very important to understand that over and above being an oil producing area, the Middle East also has some chemical production facilities in place. And also because of cheap energy, you'd see something like big aluminium smelters happening or sort of being built and aluminium being produced in that area. And these prices also have had an impact because they've also been bottlenecked to some extent. And then also all of the products sitting outside of the bottlenecked areas is clearly going to pick up some price benefit. And what we're showing you in the graph here on the left-hand side is this acceleration that occurs once again in some of these prices from the 1st of March. So when we start looking at some of these commodities, we need to understand how they ultimately will play out in price increases / inflation for average consumers. So just having a look at some of the detail that we have in here, we're looking at natural gases as they move into Japan and Korea. We're also looking at urea, which is a chemical that is used quite extensively in the production of fertilizers. So when we think oil, we don't just think about diesel, we have to think about downstream. We have to think about ultimately what it means for food production. If you have crimping of supply in things like fertilizers, what that means for food prices. So higher food prices is a squeeze on households. As we sit here and we have to pay more for the same groceries, it means that we've got less money to allocate to other areas of our lives. But at the same time, interest rates also move to try and crimp the price escalations that come through, and hence you have higher debt servicing costs, which further crimps the consumer. And let's just say at the outset that consumer is not a Middle Eastern consumer, it's not an American consumer, it's a global consumer. We're certainly feeling it in South Africa, and I'm very certain you're feeling the same impacts in Lesotho. So it really is about take-home pay. It really is about how much money circulates in the economy, and this concept that oil price to some extent for those that have to import it does come through as a tax. And we're just showing you average gasoline prices here in the US. And the US does produce and are self-sufficient in energy supply. They're actually a net exporter. Places like South Africa and Lesotho, obviously we're very much in the front and center in terms of the pain that we need to go through in supporting higher energy prices. So an already stretched consumer, specifically in South Africa, certainly is feeling the brunt of this higher oil price. As retirement savers, I think we need to recognize that this is a cycle. We'll move through the cycle, and ultimately we need to invest for the longer term. We need to look after our future selves. We may tip into a recession on the back of this inflationary buildup. We're obviously watching that data very closely. We don't think we're close to that point yet, but certainly I think the point is you need to invest through that cycle, understanding that structurally you're looking after your future selves. If we then just try and break that down a little bit and try to understand why this energy is so important, The knock-on into politics is very direct. And I think for us, just the conversations we've had revolve around something like China and China's buildup of inventory over many years puts them in a situation where they moved into this conflict with many barrels of reserves. And hence, if you look at the mainstream press, you haven't seen much commentary out of China as it relates to their involvement in Strait of Hormuz, the conflict with Iran, and they certainly politically haven't really been a major player. And I think it is because they never reached a drawdown on the inventory that started to hurt them. And you can see on the left-hand side here where a lot of those inventories have sat. Japan probably the most impacted by these higher oil prices, and that they didn't have enough reserves to support the economy through this period. Importantly for us also on the right-hand side is maybe a little bit of a tongue-in-cheek graph on jawbones and the way that we've seen an acceleration in futures prices on oil at the point or just before the point that we've seen some very explicit comments coming through from the US presidency on social media. So big movements here, you can see them. And as investors, I think it's important for us just to recognize that we're never going to catch these points. The easiest way to lose a lot of money is to try and trade out and back into this volatility. We've got structural views that we invest to, and we'd invest through these cycles, but being very conscious of them. So, as I said, the politics of oil is very important to assess and keep track of. And in this graph, we're just showing you this period in time where we've seen a significant escalation in geopolitical risk index. This comes out of one of our research partners, BCA, out of Canada. And here we're showing you basically that very high or elevated level of geopolitical risk. But as importantly, it is concomitant with a big spike in policy uncertainty. And that policy uncertainty is really a function of higher inflation and central banks having to adjust or pivot monetary policy to accommodate this perceived increase in inflation. So, we're sitting at a period of elevated risk, and having diversification in the portfolio and having discipline around the investment strategies that we have in place is very important. And I think also what is very important is to understand that this is cyclical, the expectation, and even now you can see some of these lines are starting to move down again, and investing through that is important, and not trying to time it once again will be the best solution and outcome. So if you're panicking now, it's far too late to panic. Within the portfolios that we manage, we started making adjustments already early in March. Just to elaborate a little bit on that, here we've got the market implied inflation expectations, and you can see basically from the end of COVID, we've seen most global 30-year treasuries, which is effectively how governments fund themselves, moving in an upward direction. Upward direction, remember, we're talking about interest rates here, means that the cost of debt is on the up and up, and it's becoming more expensive to fund fiscal and trade deficits. So it's quite important, an important measure for us to assess where risk-free rates are globally and how other assets should be valued. So the question really then becomes, traditionally the US dollar has been a safe haven and US treasuries have been a safe haven. Is that still the case now, or do we need to make some adjustments given the change and the pivoting in these long bonds? So, once again, as a member of a fund, rising inflation and rising government debt costs are important to assess. But at a fund level, we try to diversify away from some of those risks. We also understand that there is quality away from US assets, and we're positioned for that. And ultimately, we'd look to protect investors' money in real terms. In other words, considering price escalations over the longer term. Very importantly, historically, when you see these oil shocks, they normally result in periods of recession. Recession basically is a situation where you have negative GDP growth in an economy. And the mechanism is quite clear for us, is you have higher oil prices. It acts as a tax on consumption in businesses. Those businesses no longer have as much money to purchase goods and services, and hence you see market activity slow down, which is pretty much the definition of what a recession is. Once again, downturns are part of our lives. I think Riaan and I have been through our fair share of them. And we build investment processes to design portfolios that you can feel secure about and through these type of periods. Quite interestingly for us is on the next slide, we talk to the growth outcome or growth outlook as well. And despite this higher oil price, we certainly have seen a resilient expectation around growth, and actually trailing growth has also been fairly strong. I'm showing you the IMF data here, the International Monetary Fund, which typically is a fairly conservative stab at where we think growth is going to be. And we've just highlighted in the red blocks there, the US and South Africa. And you can see that inflation has remained fairly stable through a period of war, in the shadow of war. And if anything, the growth numbers that we've seen come through have been ahead of expectations. So quite pleased with that. The markets have been very resilient in this particular environment, given that conflict and given the potential slowdown in GDP growth. And I think if you had disinvested, you certainly would have done yourself a disfavor in that the recoveries that we've seen have taken us to higher levels than the starting points at the end of February. So, we need to stay resilient in periods of uncertainty. The other the biggest surprise, I guess, that has come through for us is the resilience in earnings. And earnings, basically the company's ability to earn profits in current market situations. And S&P 500 on the left-hand side here, you can see very strong earnings growth coming through, better than 25% in the first quarter of 2026. And so certainly no slowdown coming through there. And if we just look at other countries, you can see earnings growth also very strong, even in places like South Africa, where in the last earnings season we delivered 61% earnings growth. So certainly in the face of higher inflation, slowing or perceived slowing economic growth, corporates are still earning strong returns. And I think the important takeaway is that you need to diversify the portfolios, make sure that you focus on the quality of the businesses you're buying into, and blend that with obviously some assets that will reduce the risk of the overall portfolios. Then just very quickly, I want to highlight three themes that longer term we think are playing out, and certainly we need to invest into and keep abreast of. The first is a big surge in CapEx spend on AI. I'm not too sure what the penetration of AI is like in Lesotho, but certainly in South Africa, it feels like the penetration doubles every other day. And we need to also understand that these numbers are significant. So you're moving from roughly $650 billion to about $1.4 trillion in the next 4 years. So very significant spend coming through, and that means that there will be a rotation away from other areas of spend as there's a ramp up in spend in AI. Going sort of hand in glove with that is a big surge in demand for energy. To give you a sense, if you're running a data center and that data center happens to be cloud focused, and you transition that into AI, the pickup in energy consumption is about 75%. So significantly more energy having to go into AI than into cloud, which traditionally we're more aware of. So the transition in energy and the capex is also accelerating quite quickly there. And then I think the third theme that we're keeping a very close eye on is the spend on defense. And I must say, I think this to me is a rearmament in Europe mainly, but certainly the outbreak of conflict in the Middle East does mean you've seen acceleration in some of the spend. And the numbers move from about 2.8 trillion in 2026 to about 3.4 trillion in 2030. Once again, there's a competition for capital here. There's a competition for money. And as long bond yields move higher, the amount of money that governments have and required to spend in this space becomes more difficult. And obviously we need to take that spend from somewhere else. So I know that's a very quick snapshot of what is happening in the Middle East and what we think some of the key themes might be going forward. I think that ultimately we need to put together diversified, well-structured portfolios, and we need participants to believe in the strategies that we put in place and invest alongside those through these periods of turmoil. Turmoil typically is cyclical, and the last 3 slides that I've shown you really are what we would see as some structural benefits in the longer term. So, yeah, I think very importantly, how do you position a portfolio with that as a backdrop? And I'm going to hand over to Riaan just to give you a couple of his thoughts on that.
Thanks, Marc. Good afternoon and good evening, everyone. I'm sure after Marc's talk there, when you look at your retirement savings, you'll probably feel a knot in your stomach. So I want to deal with that tonight. And let's deal with that honestly up front. Yes, wars, geopolitics, those do move markets in the short term. But as Marc pointed out earlier, I think what really happens to your retirement money over the years ahead depends far more on how you behave than any other war or headline. So it's uncomfortable to hear that, but it is quite liberating, when someone spells that out. So hopefully by the end of tonight, including some of our panel questions and discussions, you would hopefully understand what actually happens to markets after some of these frightening events. I'm going to show you, real data going back a few decades, and to echo again what Marc was saying, why reacting to the panic is usually the worst thing you could do. So, this chart up here looks quite busy, but it tells a very simple story. The gray bars show how the world's biggest stock market finishes each calendar year, while the red dots show how far it fell at its worst point during that same year. So let's look at the red dots first. Every single year, without exception, the market has dropped at some stage. On average, about 15% along the way. But there were some scary periods there, 2008. I think most of us remember COVID. The market fell about 33%. So it's not rare when markets fall. This happens every single year. But if you focus on the gray bars, despite all those falls, the market still ended in positive territory in 29 of the last 40 years. So that's roughly 3 out of 4 years. Even after a scary drop, you still finished ahead. So So market falls during the year. It's not a signal that anything is broken. I just think it's the normal course of events as you go through of being an investor in calm years and in years where there are wars or geopolitics. So I think it's, I think of it as a long haul flight that hits turbulence. So those bumps are uncomfortable, but the plane still lands where it is meant to. And the only way to get hurt is to try and jump out mid-flight. So now, if the previous slide was accepting that falls are normal, I think this one is about your single biggest and greatest advantage that you have as an investor, and that is time. So what this graph shows you is how often you would have made money depending purely on how long you stayed invested in. So let's start on the left. Over just one day, it's almost a coin toss. You lose money half the time and make money half the time. So that's exactly why checking your balance on a daily basis only makes you more anxious and tempts you into making bad decisions. So as we follow towards the right-hand side, you can see over 1 year you were positive about 8 out of 10 times. Over 5 years in a balanced fund, which is the green bar, that was positive 99% of the time, going back all the way to 1989. And then over 10 years, the graph right on the far right-hand side, you never lost money, not once, over any rolling 10-year period. So I would say to you guys that, and we certainly believe that too, that retirement saving is not a 1-year project. It's often a 10 or 20 or even sometimes a 30-year journey. And on that time frame, a war or a political event barely registers. So, what our greatest ally is here is time. And it's something, that turns investing from almost being like a gamble or a casino into something close to a certainty as you extend your time frame. So, and I would say if you compare the grey and the green bars to each other, the green one is more positive almost on every single occasion, because that is a diversified portfolio to what Marc spoke about earlier. It's not only invested in shares, there's investments in fixed income instruments, in cash, in property. So you have the ability to cushion the blow, and ultimately trying to smooth the ride so that you can stay on board long enough for time to do its job. And I think this slide, what we try to do here is really to try and answer tonight's question as directly as possible. What actually happens to your money after a war, after a crisis? This is real data going back to the 70s. So each cluster of bars really shows you some of the most frightening moments of the last 4 decades. The Gulf Wars, the Asian crisis, 9/11, the global financial crisis in 2008, COVID, and more recently, the invasion of Ukraine. And so the bars show how a balanced portfolio, in fact, did 1 year and 3 years afterwards relative to cash. So has it outperformed cash on a 1-year basis, which is the gray, and the blue bar is on a 3-year basis. So if you just focus on the blue bars for a second, 3 years on, they're almost universally positive. And on average, if we take all these big events, those investors who stayed invested for that period were about 22% better off over those 3 years than those had fled to cash. So that's it, just 22% for just staying in your seat. But I mean, it's possible that even on a 1-year basis, you do have some negative returns there. I can see 9/11 as an example, and even Russia, Ukraine. But if you stay invested, you've won almost every single time 3 years later. So the moment that feels most terrifying is when everyone is selling and the news is the darkest. and that's historically been close to the best moment to just stay put. So cash does feel safe. I agree with Marc. Sometimes it does. But over time, it's usually where what we say where returns go to die. So when the headlines are screaming, my advice would be to do nothing really dramatic. So that's the history. So just the next, and I think a fair question is, where are we right now? And this is sort of an honest map of where we see it. Really drawn as a seesaw, because that's certainly what it feels like, specifically with Trump tweeting the whole time. So on the right, you can see some of the headwinds that we're facing in South Africa and globally. Oil shock, obviously, at the top of that list. Geopolitics, government debt. I don't think it's anything that's been hidden away. And then on the left-hand side are some of the tailwinds that really make the headlines. So, in South Africa, there's been a reform happening over the last few years. We've been fixing our electricity and logistical issues. To Marc's point earlier, the world's pouring money into AI and the productivity that it's going to bring. There's strong demand for our commodities. And then lastly, just valuations from a South African equity perspective that certainly look very, very attractive. So, in the middle is some of those balancing points, inflation and the path of interest rates. So, I think the point is really this: anyone that's trying to tell you that they know exactly what happens next is guessing, however confident they may sound. And our job is really not to predict which way the seesaw tips, but really to build a fund and a portfolio that can cope and withstand, and can keep growing whichever way it tilts. So just how have we put this into practice? And so, everything that we've discussed today, Marc and myself, and this is what it looks like inside the portion of the fund that we manage. So I would say, first of all, we never rely on a single manager or a single view. We've partnered with what we believe are some of the world and South Africa's best specialist fund managers. You can see some of the names on the left-hand side, each with a different style, with a different strength. When one has a difficult year, the others can carry the load. So no single bad call can sink you. And then the second part on the right-hand side is the asset allocation. So your money is spread deliberately across different asset classes. There are some equities, some fixed income instruments, property, and then roughly about a third of the fund is invested offshore, in line with some of the prudential rules and regulations. And that is really the shock absorber. So typically when South Africa has a tough time, the rand weakens and those global assets sort of cushion the blow. So, this is real diversification that we've tried to put in place, across managers, across asset classes, across countries, across investment styles. So we still believe, no single war, no single bad decision, and no single country's troubles can sink the whole ship. So I would bring it together with, I would say, three things just to carry home, and then I think we're going to go into questions. The first one is market falls are normal. They happen every year. They're not the same as losing money unless you choose to sell. So I think that's an important one to remember. Secondly, time is your ally. The longer you stay invested, the more certain a good outcome becomes. And then lastly, after every crisis in history, the patient investor was rewarded. So I think, when we try to construct this portfolio, your retirement fund is built exactly for this uncertain kind of world that we find ourselves in. Diversified, professionally managed, designed to weather the storms none of us can really predict. So, our role and your fund's role is to be the steady partner alongside you, so that you never have to make these calls on your own. And for us, that's why we have this partnership.
Okay. Thanks, Riaan. I'm going to stop sharing there.
Talked a bit long.
And Siali, maybe hand back to you to moderate. I think we're moving into a panel discussion now. It's nice to see the numbers on the Zoom call have increased as we were presenting, which is always a sign of hopefully stimulating conversation and sets us up quite nicely for discussion.
For the discussions. No, I was actually looking at that myself, and I'm glad I saw the numbers going up. Of course, it's important that I also like the way you broke it down. I think everyone understands to some extent where the linkages are, and as you say, where the opportunities are. I hope you were all listening. I think Riaan told you not to check your balances, just swipe, 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 and never to check your balance. But of course, what he meant is that, as the case is with me, is stay away from your easy equities account, stay away from your STANLIB account. Just let the markets do their thing. But importantly, they say time and diversification are your best friends. This we are in this for the long haul, and we've noted that if there's a dip, then markets will always come out of that even stronger. I'm going to ask Mema Khotso to share on her side as I speak to the bios of our panelists. We are sort of running out of time, but if you allow us perhaps an extra 10 minutes, I think it will be worth your while. Mema Khotso, if you would. And then as we do so, I will be addressing or really directing some of our questions to our panelists, just for them to further unpack what is happening, what is an investment. Maybe we'll start there. What are some of those, what is the jargon, what does it mean? And now that, of course, Marc and Riaan have told us that just stay put, allow your investments to work. What should I do as an investor, and what should they do as our own fund managers? I believe you have rights to share, if you would. So, we move to the second phase of our webinar, where now, after this engaging presentation, we will then go into a panel discussion where the experts themselves will be answering some of the questions that I believe you've had asked yourselves at least once since February 28th, 2026, when the US and Israel launched attacks on Iran. It is quite interesting, though, to say that as of Friday, I believe, there was some sort of deal that was signed by the US and Iran, where luckily we saw oil prices go down. So we do expect that perhaps that is going to filter down to us. Right now, we are sitting at about 31% in transport costs. At some point, we had to pay 35 maluti per liter of diesel. That's gone down luckily to about 30 maluti per liter of diesel. We hope to go down further now that the deal has been signed. But now, as Riaan also pointed out, we are also conflicting between what is happening with the US dollar versus the rand. So yes, when the South African currency goes down, unfortunately, it means we technically pay more. All right. I'm just going to go ahead. I think Mama Khotso is going to share. I think she's not here. Can I share my screen if you allow me? Just to introduce the panel. All right, I'll begin at the very top. We are joined by our two previous speakers. Riaan Wagner is a co-fund manager of the World Access Fund of Funds, and he's also a lead fund manager on the domestic multi-manager portfolios. He just presented one of the multi-manager portfolios that he looks after, where his role really is to make sure that he brings on board proper managers for our own investments. I must say that our own Alliance Segregated Fund has investments in that sort of portfolio. So he works mostly as well in research and the selection of local and foreign investment managers, and he's responsible for the quantitative analysis of the investments. He's also garnered experience as a portfolio manager, and he's worked as well in both equities and fixed interest portfolios. I'm going to go to our next Sesh. She says we shouldn't call her Sesh. Sesh has held the position of manager and head of employee benefits for more than 13 years at Alliance. She's currently pursuing her MBA through the University of Pretoria. She also has a background in actuarial and financial mathematics. And just like Riaan, Marc works closely with Riaan. He is the lead portfolio manager responsible for multi-asset and Regulation 28 mandates. Perhaps later he will speak a bit about what multi-asset and Regulation 28 actually mean. He's responsible for portfolio construction, asset allocation, and investment outcomes across client portfolios, just like the investment that the Alliance Segregated Fund holds. Marc is a CFA charter holder and has also acquired a higher diploma in tax from the University of Johannesburg. Marc has been in the game since 1995. Maybe I'll let that sink in. And then joining Marc and Riaan, give me apologies. Ke Lerato Sekantsi-Fuma. Lerato Sekantsi-Fuma is a wealth manager and institutional investment consultant with a certified financial planner and wealth management specialization. She has more than 10 years across South African financial services. And she specializes in designing tailored investment strategies, managing financial risk, and corporate employee benefits. I really have a question for her relating to how she constructs such portfolios. At least now that we are going through market risk events such as these, how she would have constructed a portfolio for that. Ntate Mokoma is with STANLIB Lesotho. He is a business development manager, and he has more than 13 years in the financial services and employee benefits sector in Lesotho. He has been to NUL, he's been to UNISA, he's been to Stellenbosch. I'm not sure whether he's an investor or he's a student. I think it's very interesting that we have amongst us such a learned investor for our discussions. And that without taking any more of the time, I'll just hold it here and then stop sharing and then move straight to the questions. Also, our audience that please, if you also have questions, please type your questions in the chat, and then we'll be addressing those as we go. Marc, let's go back. I imagine one would feel they would try to be sophisticated, if you will. They'll try and follow financial news. They'll try and see what's going on in the world out there. In fact, they'll even open their retirement investment and try and make sense of it. But we hear words like inflation, interest rates, volatility, yields, derivatives also being thrown around, and that could really throw someone off. But for someone who's not in the finance space, what are these key terms? And in the events such as the Iran conflict, how do they come into play?
Perfect. Thank you very much. I mean, that's a very broad question, which I'll hope to give some justice to with maybe a bit of a shorter answer. Riaan and I sit in a team of investment professionals. I think that being in that team, one of the key skills we probably acquire, I don't think you can learn it, is understanding what is important and what isn't important. So news flow is always there, and being able to digest that news flow and understand whether it is a pivot point in a portfolio or whether it's just some noise that you can move through cyclically is quite important. When it comes to the jargon of the market, I think that a bit like doctors, we maybe have our own little secret language. But I think that we can really distill all of the jargon in the market into a couple of key points. I think the first key point is that, as we always hear in kind of financial press, don't put all your eggs in one basket. So we start talking about something around the edges of diversification. Understanding that in the World Cup, if Bafana don't play well, it means somebody has to play well to go through. I can't back both teams, but you certainly can watch all the games. So don't put all your bets onto one team through the World Cup. Maybe have a couple of teams that you like and place bets into various areas, certainly into various groups, because various groups are going to move through the stage setting. So the idea is, when diversifying your portfolio, you need to take that approach too. And then really, we think about investments in the sense of return opportunity versus risk. And without simplifying it too much, every asset and every opportunity has a risk and it has a return. And we'd like to blend those so that we can optimize the return given the mandate that clients place on us. So maybe just on that Regulation 28 comments, that would be the regulatory framework in which South African pension funds need to allocate assets. And then we can get into the jargon of, what is fixed income, what is an equity, what is a derivative, what is a swap, etc. But essentially, these are just different asset opportunities that have different drivers. And when we blend them together in a portfolio, we're hoping to optimize the return that we can get at any given level of risk. And to move back into Riaan's point, you could invest everything into cash, but that certainly is where I think that the phrase that he used was where alpha goes to die. And essentially, alpha is our ability to add returns above the benchmark or the expectation. And that's what we try to achieve every day through blending these assets together. Is there any merit in having a discussion about what an option is inside this forum? Potentially. So the option is the derivative is the ability to hedge out some of those risks or accelerate some of those risks for the opportunity for higher return or more stable return. It's something that we typically don't employ in our processes, in that we believe that if we're going to invest into, for instance, an AI business, and that business happens to be in the US, then we recognize that we need to take on the currency risk at the same time as the equity risk, and we're happy to do that. But certainly we would mitigate it by investing into some other areas at the same time. I think I've answered your question without answering it. At the end of the day, this is what we do all day. This is what we focused on. And for us, I think the important part is not to focus too much on the news. Understand the direction that you want to take a portfolio in. Understand and recognize where you have a cyclical change, which I think we've just gone through twice, actually. We think we pivoted on the 1st of March. and we think that we're at a pivot point again now. So it's time to reconsider the risk-off situation in the portfolio and actually apply a little bit more risk into the portfolio, because we believe the return opportunity is there, as I think Riaan alluded to specifically on the SA equity side. So without diving into too much detail, fixed income and bonds are how a business funds itself or a country funds itself through some lending activities, which is very sensitive to interest rate policy. Equity businesses may benefit from interest rate policy. Certainly, they have to pay away for any lending that they do to build their businesses out. And, blending those two together, you can kind of recognize that they have very different responses to interest rate policy. So higher interest rates in Lesotho, higher fuel price in Lesotho means there's less opportunity for people to spend in discretionary retail. So you've got to start thinking about whether you want to hold equity in a business that participates in that market. So they may be counter-cyclical in that interest rates may remain flat while putting pressure on a business. They offer you as an investor quite a nice low risk return opportunity. I think maybe let me just leave it there and see if any questions or any additional thoughts come through from the panel.
Thank you there, Marc. I think you did well by not really speaking so much about the Bafana, maybe not even qualifying for the next round.
That's called hedging. Hedging myself.
But yeah, maybe there's a chance they'll qualify for the next round. That is, I've had the actuarial guys look at this. So if Bafana beat, I think, South Korea, and if Mexico beat the other Czech Republic, then Bafana has a chance. But hey, that Bomilabont, I also noted that there's a question in the chat. I must say, for the interest of time, really for the sake of time, let's just maybe be specific to the topic, to today's topic instead of other questions. But of course, if you have other questions, you are always welcome to direct those by email to Sesh and Me Mahotso after this session. And we are really focusing on the Iran conflict, but Riaan and Marc have also showed that markets have been through a lot. They've been through all sorts of conflicts. So please help us understand that why would someone in Lesotho care about what is happening globally? And is there a direct link between those global events and my investments in Lesotho as a Lesotho?
Thank you very much, Ndadisuri. And yeah, I think to a certain extent, Marc, I'm not sure if it was Marc or Riaan who would have already gone into this phenomenon. But, around the 1960s, we had a phrase, the world is a global village. And that really in itself explains why one would not take for granted things that be happening, however far away from home. So because of that, really, a globalized economy means what happens in Russia, what happens in Iran, what happens in Israel comes down to me. I think every one of us in Lesotho now knows that fluctuations in things like your petrol, diesel, can be as a result of such. And this is really just because the world is now transnationalized. Our commerce is transnationalized. The things that we use in Lesotho, we import from elsewhere. And it is important to understand that whatever happens there has a bearing on what happens here. Let's just talk supply chains. Marc talked to the fact that there was such a degrading of traffic through the strait. And we know that what goes or what transitions through that strait really is a lot of things, some of which may find themselves on our borders. So it means that now our supply chains have been stifled. There are bottlenecks. There is imports that some of us, maybe even farmers in Lesotho, would want to use that we cannot have. But to the topic of today, for pension fund, this is even more interesting because pension funds invest in various types of assets. And a lot of these assets, some of them are even global. And what that means is they could have bought stock, and that company could be operating with the need for some of these things that I'm saying are not being or are not moving through the strait. What that means is that such companies, the valuations that had been done and things like that are no longer holding true. So whatever money you have been holding in your pension fund, when it had been valued to be at a certain value, it may have to be reevaluated, and it might go down simply because some people somewhere decided they couldn't agree. So you see, you may be sitting in your home, you didn't take out any of your money in your pension fund, but what happened between two countries far away from you has resulted in a negative movement in your retirement fund. So we cannot disregard what happens globally, mainly because it has become such a village, and it does directly affect us. Thank you.
Thank you, Nat. I was just thinking that, I think before, I'm just going to put myself out there, before the 27th of February, I mean, my geography class was a long time ago, so I didn't know what a strait was. So, and I think I'm not the only one who didn't know what a strait is. Maybe also due to the fact that we are a landlocked country, so we don't know what a bay is, what a channel is. So if anyone in the audience knew what a strait was before the end of February, please let us know. Lerato, I'm going to bring you in here. Now that Mokoma has really said we are a global village, so it means if you were sitting in front of your television and seeing a global risk event occur on the 28th of February, you wouldn't ignore it. Now, the question is, should investors be rushing to sell their investments when such events occur? Or what are, in general, some of the common mistakes that investors make during these uncertain times? Because you might find that the risk is not in the event itself, but it's in how we react to that.
All right, thank you, Dad. I think when Riaan and Marc were talking, they have alluded a lot to behavior. So I think we call it behavioral analysis, where we see that a lot of people, in terms of our behavior, our emotions sort of take over, and that's what informs our decisions. So we now need to be disciplined and try to say, what are we looking at here? Because like they said, there are news all the time. And if we're going to let our emotions do the deciding for us, then it means that we are going to lose out. Withdrawal in these sort of times where there's turmoil and we see our investments sort of dropping or going down leads to permanent capital losses. Because if I had 100, for instance, invested, and then I'm going to disinvest at 60, it means that I have lost that 40 rand per se, or 40 maluti in my investment. And because I have disinvested, it means I'm never going to recover that money, and I have lost it permanently. So we need to get to a point whereby our emotions are not driving our decisions, but we let the professionals who know what they're doing and have portfolios that have been positioned to be able to ride out these sort of waves or downturns in our markets. So the best thing that we do is we do not react to the news. We take note of them, put them at the back of our minds, but let the professionals do the work for us. Because at the end of the day, if for instance, I'm already nearing retirement, it is very important for you to stay invested and not leave or exit the market.
Do not panic sell. Do not let emotions make your lifelong investment decisions for you. Sometimes you just need to sit back. And sometimes you're told that the best action to do is actually to sit back and do nothing. Lerato, I'm going to stay with you. I did say that I have this question for you. You have constructed investment portfolios for private clients, for institutions, for retirement funds. So please enlighten us here. How do professionals position portfolios to reduce the risk during such uncertain times as we saw with the Iran conflict? And do these positions that you take, are they taken in advance, or are they taken now as a response to an ongoing conflict?
Okay. All right. So first of all, to address the selection or to try to manage the risk is there's diversification. The previous speakers have talked about diversification through the different asset classes, through the different asset managers, diversification geographically as well, where they were invested in South Africa and invested offshore. So diversification itself is a risk management tool to say I'm not putting my eggs in one basket, but I'm spreading myself wide so that if any of the areas in which I'm invested in goes down, then I'm not exposed to too much of the risk in that particular area. So that is the main thing that we want to look at. Are we well diversified? And if the answer is yes, it means during these times of turmoil or downturns, we shouldn't be panicking. The best thing is to say we shouldn't be reactive, but we should be proactive. If a portfolio is well positioned, even during times like this, the asset manager has already thought that something like this can happen and are well diversified and are not exposed. So I think most of the time when asset managers make their decisions, they're calculated decisions that have also taken into account the risk of the different assets that they are invested in.
Thank you, Ma. Again, that is a very enlightening, a very enriching response. I think it again addresses what you said earlier, that a portfolio is constructed already thinking of the possible downturns and providing protection for those instead of chopping and changing as and when risk events occur. I'm going to bring in Riaan here. Lerato did also speak about all eggs in one basket. It's interesting because I've never heard of that expression outside of investments. Maybe it's because baskets break a lot, is it? Now, Riaan, during times like this, as an investor at home who has entrusted my portfolio with yourself and Investec and Alliance and STANLIB and Lerato, what are fund managers actually doing behind the scenes to protect risk and also to protect our investments?
So I think at the heart of what it is we do and some of the partnerships that we formed with our fund managers is really to fall back on your philosophy and process, and ultimately be your North Star. And having had the experience of managing a lot of these mandates over significant periods of time, it takes 25 years to get 25 years of experience. So it's learning from some past mistakes. It's forming a robust debate investment process to ultimately try and provide our investors with the best possible risk-adjusted return. It's looking at areas where the opportunities are where you're being paid to be invested. So, at the heart of all of this is really your prospect for future return is the price you pay for an asset today. So if you have the ability to invest in cheaper assets, maybe it's because of what happened with the war, and for no particular reason other than the headline, markets have sold off. That could be a great entry point. So that's really, I guess, going back to that, at the heart of what it is we do, follow that tried and tested investment process, to ultimately give our clients that sleep at well night portfolio, that that you've partnered with professionals and guys that are experienced in doing this.
Maybe if I can jump in there quickly and say something that's quite close to my heart is, Riaan and I will take action when we need to around global events, and we do so that the underlying investors don't need to. So we need to kind of demyth the spell that we've maintained our fund manager selection and asset allocation through this whole process. Absolutely not. We have seen some subtle rotations, but certainly what we don't do is have wholesale changes.
I agree, and I accept that point, because as you said there, with sticking to your philosophy, sticking to what you know, you don't want to be chasing trends. I mean, if that was the case, we'd all be invested in gold mines in 2025, perhaps invested in Starlink now, or even Bitcoin, because there's an acronym, FOMO, the fear of missing out. So when we hear the news that Starlink is valued at some $1 trillion, and then we think that's where the money is, perhaps the professionals would know better as far as that is concerned. In terms of managing the portfolio, Sesh, I'll bring you in here. Portfolios are made up of, importantly, employee contributions and employer contributions, and you will find that there's always a range of investments or amount of contributions that the investor or the member can make. Would you then advise that members, especially young members, should maximize their portion of the contributions as early as possible, or worry about it when they have 5 years to retirement?
Thank you very much, Nedesodi, for that question. I think for us as pension fund administrators, we always say time is the best gift you have. I think Marc did talk to it when he was going through his presentation. The best tool that you have on your side is time, and you'd better take an opportunity whilst you have time to put more into your investments. I think the difference that time has on your investment is far greater than even this global, ups and downs. So definitely, straight to your question, it's most important for a young investor or a young person who has just joined a pension fund or a retirement fund to put more towards their retirement fund as early as possible. It will definitely thank you later. Once you get to that retirement age, you will see the rewards of the money that you put in early into your retirement fund. I think also having dealt with a lot of members that are going to retirement, having done a lot of those retirement counseling sessions, I'm sure Lerato is also aware of them. You find that the biggest regret that people who are going to retirement have is the fact that while they had the time to put more into their retirement, they didn't make that decision. And you find that later on, when now it's time to retire. For example, imagine retiring during a time such as this. Imagine your retirement age hit in March, maybe the first week of March. You can imagine the impact that would have had on a member that was leaving the fund at that point in time. But if you are such a member and you had planned your retirement well on time, that initially when you joined 30 years ago, you made sure that you maximize your benefits. For example, in Lesotho right now, the Income Tax Act on the superannuation funds allows us to contribute up to 20%. of our income into the pension fund without having the tax implication on it. So I think it's quite important for all pension fund members to maximize the 20% while they still can, and at a very young age. Even if you are now older, this is quite important to take advantage of that 20% maximum contribution rate. Thank you.
Thank you, Sesh. No, you're right. It's not timing the market, but it is time in the market. So it's also important to be invested from an early age where you can, and let the market do its thing in what is called compound interest. I'm going to allow for questions from the chat. Yes, I believe the recording will be made available after this. And then while we do that, please, Marc, if you would, there's a question. We've seen that the UAE has left OPEC during this conflict. What does that mean? What does that mean for global oil supply? And would it then impact petrol prices in turn?
Yeah, I think a very brief answer. I haven't done a full assessment of UAE contribution in barrels to OPEC. Certainly, they're one of the smaller producers in the region and one of the smaller members of OPEC. Just remembering that OPEC essentially operates as a cartel. There's also OPEC Plus, which is OPEC Plus additional members. And certainly, I don't think them leaving OPEC is a signal that they're going to stop producing oil or supplying oil into the market. And I don't believe that their supply is significant enough to have a material impact on oil prices, certainly not immediately. I think, as I said to you, the politics of oil in one of my slides, I think the more important questions are around what does this mean for the alliances within the Arab world? What does it mean for some of those blocks? I think we watch more closely on that rather than the impact on oil price. But as I mentioned earlier, there's a lot of news out there. It flows all the time like a fast river. We've got to be a little bit careful that we don't get washed away by it. But certainly we'll do some assessment of it. When it comes to these type of questions, Riaan and I are very privileged to have a significant research team within the organization, and certainly would take some views from them. But I stand to be corrected here, our exposure directly into the UAE, into UAE equities is, I would say, insignificant at this stage.
All right. I'm going to then move on. There's another question in the chat. I'd like the panelists to take a look. But in the meantime, I'll go back a bit to the administration of investments and bring you in, Mokoma here. Investments are made up of two things, really. It's my contributions, which make up the bulk of the transactions. And of course, there is going to be disinvestments as well, if we are talking in terms of, say, a pension fund. And these might happen at different times, including during the March to April time, when markets were really taking a downturn. But how do these inflows and outflows affect the performance of the fund as a whole during these volatile periods?
Yeah, I think for somebody who's trying to exit a fund, it's a little bit of a difficult time for them. Like we did say in the beginning, that there will always be these shocks in the market. There have been a lot of shocks. Riaan showed us some of them. the Arab Spring, the wars. Then we had COVID most recently. We had Russia, Ukraine in Eastern Europe. We're having what is happening there in the Middle East now. So this is just a lot of shocks that have been in the market. There will always be these shocks. It may be unfortunate for somebody who's leaving the fund at that time, mainly because during that shock, your retirement funding maybe the value has gone down to a certain extent. And you leaving the fund means that you would crystallize that loss. For a lot of people, that's just a loss on paper. It's really what would change. And I think for a lot of us that were invested during the COVID years, you saw what happened then in March when lockdowns were announced, and what happened sometime in September when the markets rebounded. And we closed that year as if there was no COVID. We were in the positive, as if nothing had happened. But for somebody who had then to leave the fund just immediately when the lockdowns were being announced, they may have experienced that their funding had gone down, and they crystallized that loss by having to draw down on their retirement fund. So it only becomes a loss when you actually take your money. But before then, it is a loss on paper that you can always recover when the market rebounds. And for a lot of people that would have to now be withdrawing their monies out of these pension funds, perhaps you may want to have a look at, does my fund allow me to be a deferred pensioner that I cannot take my money at this time and maybe just leave it in there for some time, or wait for a recovery if you can. For some people, I hope that when that happened, you had been, like Mayor Sesh has just said, had been in the fund long enough that whilst there is this dent in your retirement funding, you still have enough that you can still live off even after employment. And that is very important. If you have made all the contributions that you would have made over the years, and you have allowed yourself the benefit of time and compound interest, you would be able to, even if during this time, you have amassed enough in retirement funds that you would still be able to live off of this money that you have made all these years. So there's not much that you can do to stop the shock. But you have some actions that you yourself can take to make sure that you lessen the effect of the shock. So the war is here, yes, but is it a must that I cash out on my money now? Maybe not. And if that's the case, maybe you should not do it. Because the loss becomes a loss only when you crystallize it, only when you withdraw your money from the fund.
That is so true. That on paper, let it be a loss on paper, but do not convert it to a physical loss by disinvesting. I think I have my eye on time, and I think we want to maybe be done in the next 6 to 7 minutes. So here's my suggestion. Ask the questions up front, and then let the speakers take the questions, as well as conclude their point of view as far as our topic is concerned, and even touch on the questions in the chat if you can, just so that at least in the next 6 to 7 minutes, our webinar will come to a close. So while you are still on the floor, Dr. Mokoma, you work for one of the largest asset managers in the region. Luckily, we are lucky to have your offices just outside our doors. You are also a member of the Lesotho Employers Umbrella Provident Fund Board of Trustees, and I believe even personally, you're also an investor. So one way or another, you are faced with regulation, with compliance, whilst you are still trying to serve and protect members' interests. So how do you then find that balance, or how do you then suggest that one finds a balance between regulation, protecting members' interests, whilst, of course, as a member of the umbrella fund yourself, you still want the best return out of the little less possible risk? How do you balance those? And while you think of that, I'm going to then ask Lerato her own question, so that after you speak, she will also take over. Markets are moving. We've seen news constantly in and out. The Madlanga Commission, I think one of the questions was saying that South Africans hate Africans. In xenophobia attacks, in fact, they're given up to the end of this June to leave the country. We know that there's stories of, is it Jonasi? Luckily, I don't know anything about that. So news is constant. Everything is happening at a fast pace now, with Donald Trump tweeting at 2 a.m. So what are some of the most important things that investors, especially long-term and retirement investors, should focus on? And what should they expect going forward? I think you touched a bit on this, but what should they expect going forward? And while after you answer that with your closing remarks, I'll then let Marc and Riaan to then help us understand, again, touching on your point on going forward is, Marc and Riaan, should investors then expect a slow growth, or is this now a time for opportunities? Because it must be told, as you pointed out, history repeats itself, and we've had crisis after crisis. So markets, as you said, do always recover. So what lessons should we take from these? And for Sesh, I'm going to then leave you with this question. If you could give members one bit of advice for this webinar to leave with when they leave this webinar, as well as your closing remarks, please. Thank you.
Thank you very much, Ndade. And yes, you're right. One can wear quite a number of hats. And I believe that in the environment that we exist in, the most beautiful thing is the fact that there is regulation, that I cannot do as I please. There is another eye that is watching over what affairs I preside over and what sort of actions I take. In fact, there is another eye that dictates what sort of things should happen. And should I deviate from any of those, then there is some corrective action that we take. So perhaps from your question, I can even widen the question to the individual member in a pension fund, and say that perhaps the time that we have been so passive about our pension funds and our membership in them is over. What would happen and what would it take for us to, one, understand the rules that govern our funds, to understand the environment around which our funds exist, what sort of things can be done, what sort of things cannot be done, what sort of responsibilities do we have even as members. It is interesting that since the year 2019, the Pension Fund Act was introduced in the context of Lesotho, demanding that members fill their beneficiary nominations. And this is still, it feels like pulling teeth that members still don't adhere to such. And these are just basic responsibilities. But such things should tell you that people don't necessarily understand or even take great care into what sort of things they are responsible for, or what really affects their money. I do believe that members should know who their trustees are. They should know what it is that these trustees have been doing and presiding over. You should take keen interest into all of these things. And Mayor Sesh talked about contribution levels. One should know if the law allows 20%, at what level am I? What sort of things can I do? What sort of benefits exist? Tax benefits? What does it mean? What's in there? And what things can I do to enhance my benefit? A lot of people leave employment and they start digging into that pot, and this is money that they had said they were saving and investing for when they retire. And really, your retirement formula should be contributions plus longevity, which is time, plus return, should create a me that is self-reliant, that is retiring at a better state. And with that, with the hats that I wear, I must give you comfort that there is regulation. I do not appoint myself, and you also live as a member in an environment full of regulation, full of a lot of tenets that guide what should happen and what should not happen. Take care to learn what those are, and take care to exercise your responsibilities, your rights. I think that's for me what would be important as far as what you have asked. Thank you, that.
Okay, Ndadasi, must I continue?
Yes, please. Thank you.
All right. So you have alluded to a lot of things. We were talking of xenophobic attacks, and I think I was reading the comment that most of the people are retail spenders, I'm assuming, in the SA market. I think, unfortunately for us, even if you look at Lesotho, we are an importing country. So as much as the people are coming back, but they're coming back home, and the bulk of our country is still going to import from South Africa. So that is not going to impact us that much. But I think when you start looking at it from what President Cyril Ramaphosa had said when they were trying to address this as xenophobic issues, is you see it's issues that are going to take a bit longer to implement due to the legislation and policy changes that need to come into effect before anything can really be done. It is going to provide a bit of business disruption in that sense when you think about it holistically. But to leave everyone, I think and in English we make hay while the sun shines. And I think the key takeaway there is to say that you don't know that you're not prepared for retirement up until you are in retirement. So we need to prepare while we still can, because we are always caught off guard, and we always see people every time who are caught off guard and they thought they were saving enough or they were well prepared up until certain things happen, and then all of a sudden we see that I'm actually behind where I should be in retirement. So the best thing that we can do as members, as individuals, try to put aside as much as you can, because we don't know what is ahead. We can try to plan as much as we can, but we don't know what the future holds.
I'm going to spend a couple of minutes just trying to answer some of the questions in the chat. Obviously, at the outset, Riaan and I are certainly not in a position to give individual financial advice, so please don't take it as such. You have obviously STANLIB and Alliance in the room. Please direct specific questions to them. So just in terms of access to funds, some of the Investec funds, please chat to the guys at Alliance. I'm not too sure whether outside of the platforms that we've provided on, which sits inside the retirement solution, whether they are available. Certainly we haven't listed them separately, and certainly I don't want to give you any advice on whether you can bring the money into South Africa and invest. We would love to help you out where we can. Certainly balanced funds in my world over a 5-year period have been compounding at or around 14% a year, whereas cash, I think you'd be lucky to be compounding at, in an income fund, maybe 7.5%. So almost double the rate there. So you got to be invested in risk assets. As Riaan said, and I'll reiterate it, cash investments is where alpha or real returns go to die. Just keep in mind that you're paying tax on that cash return that you're getting, and it's lower than inflation after tax. So you're losing money hand over fist as you invest there, unless you're sitting inside a retirement structure without tax drag. Okay, so I've answered that. I think there's a question here on the SARB and prime lending rates. To me, not really an event. SARB controls monetary policy through repo rate, banks price or prime. So whether it falls away or not, I think it's a way for banks to normalize the rates that they send or reference clients to, and then obviously everybody is re-referenced against that reference rate because nobody sits at prime plus this or prime minus that. So I'm not too sure what control mechanism the SARB would have other than saying to the banks, we think you're colluding in terms of the prices that you set, but each deal should be traded and priced separately. UAE, I think we've dealt with. We have a long question around where to invest. Once again, I mean, we don't give advice, but what I will say is look for structural trends. Don't get caught up by investing too much into cyclical trends. Gold was a great investment all the way through to the beginning of this year, but you certainly didn't want 100% of it in your portfolio in the latter part of this year. So blend that out with some stuff that you think is structurally beneficial. Think about food delivery in Europe. Think about AI. Think about defense spend. Look for other structural trends that you like. Two that we didn't mention is demographics. So we see global aging as a theme that you can invest into. Think about insurance. Think about healthcare. So potentially those are things that you need to scratch around. Having said that, are you in a position to invest into those themes from Lesotho? I don't know. I can't give you advice on exchange control and your easy equities account. Zioli. Yeah, that's quite interesting. All right. Yeah, take lots of meds. That plays into the theme that we were talking about, and make sure that they're not generic. Make sure that you take the originals because we'll make better money on that. And then, I mean, let's touch on the sensitive issue because it's an issue that we've spoken about when I've been in Lesotho as well, xenophobia. I see a trend, and I don't want to be flippant about xenophobia, but in election years, it always seems to rear its head. Okay, and we've got some political parties who obviously try and get votes off the back of that. And it's the old recycled story about foreigners taking South African jobs. Having spoken to some of you potentially previously, the view out of Lesotho is, well, the South Africans don't want the jobs, okay, or that they're not willing to put in the work. So we need to treat this very carefully. We certainly don't want to flare up that we saw previously. We have elections on the 4th of November. So hopefully it's something that moves out of the system quite quickly there. Yes, immigrants may be cheap labor, but they're certainly earning money and they're spending money. If we look at the way that we've positioned our portfolios, we'd have a bias towards the lower LSMs. So think Boxer over Woolworths as a food retailer. So we really like that. And we certainly don't support xenophobia. We're a business who lives in a society. We don't live off it, and that society includes all nationalities, and be they legitimately here or illegally here or refugee status. I mean, we certainly understand that it exists. We certainly don't think that it's a significant trend that would alter the way that we position. So answered all the Q&A except for obviously this yearly question. So I said earlier in the presentation, I think that we've seen two pivots this year. The first pivot was on the 1st of March. On the 1st of March, we thought there was an outside chance of 3 interest rate cuts in South Africa, but definitely 2 in the calendar year. And we pivoted as we saw the attacks in Iran, because with the buildup of inflation, we know that the SARB and Lesotho in particular are very anti-inflation. And that pivoted to an expectation of 3 interest rate hikes through the cycle, potentially 2. As we sit here today, we think that the story in the Middle East is now calmed, and we can see it in the oil price, we can see it in inflation expectations in the US, that the market believes that the conflict is over and resolution is near. And when I say near, I mean finalization of access to enrichment plants in Iran and Strait of Hormuz and a few things. And we're starting to pivot again, and we're pivoting because we think global growth will be stronger than previously expected. There's very good evidence of strong earnings growth coming through in the US and in other countries, but we think US equities are still fairly expensive, so we'd remain underweight those equities. That's not to say we wouldn't hold some. We would certainly hold a lot, but not as much as index. We think that there are opportunities in Japan. We haven't really touched on that. Yes, they're under pressure from the oil situation, but we think the yen is cheap, and we think that there is some significant corporate governance structural reform happening at equity level, which for us necessitates an investment there, given the risk return profile. Additionally, we think that US treasuries are looking a little bit expensive. We're a little bit disappointed by the breakdown of correlations of those US treasuries and gold in a period of conflict. They didn't provide us with the risk mitigation in the portfolios that we would have hoped for. But strangely enough, US equities provided us with more benefit than we would have thought. So to frame our view there is, are we getting more excited about investment opportunities? Yes. We've just come through two processes now, both globally and locally. We think that we should be risk on. We go double overweight South African or SA Inc. or interest rate sensitive stocks in South Africa, not because we think we're moving into a cutting cycle, but we think that the prices are attractive. So those are some of the rotations in the portfolio. To sum it up, overweight South African equity, overweight South African fixed income, which is another move that we've just implemented. Very underweight SA cash, where alpha dies, as Riaan keeps saying. Neutral, but extending our offshore positioning, and into that offshore positioning, a bias towards emerging market equities, Japanese equities, European equities, and all of that in the face of stronger than, well, obviously premised on the fact that we don't think we move into a global recession. Our one outlier iceberg that I'd caution against, and if you're going to make a move into global markets, just have a close look at what's happening in China. We've moved from modestly overweight China in terms of our outlook there to a little bit concerned about what's happening there, in that the Chinese government are not using monetary policy and stimulus to try and drive some growth there. So we think that there might be a little bit of a negative outcome coming through. But let's all be honest with each other. If we produced 4.5% GDP growth, or if Lesotho produced 4.5% GDP growth, we'd be very pleased with that. We'd be ecstatic. So the reference and the base is also needs to be considered. So yeah, I think just for some closing comments and maybe to frame the conversation tonight, I'm going to hand over to Riaan for some conclusions.
Yeah, so maybe just to reiterate, some of the longer term themes and how you should be thinking about your retirement fund. If you have that knot in your stomach, just know that it's normal. Market falls are normal. They happen every year. And as all the other panelists alluded to as well, it's not the same as losing money unless you choose to sell. Really, time is your ally. The longer you stay invested, the more certain that good outcome becomes. And then, just history has shown you that after every single crisis, if you were patient and didn't act irrationally, you were rewarded. So, I think that's, the message I'd leave with you tonight. Think of those three things, but also know that the partnership that we have with you, and the way that we've structured the fund and the portfolio, is built for an uncertain world. It's built on the premises of diversification. It's managed by ourselves, and really at the end of the day, it's designed to weather the storms that none of us can predict. I don't think any one of us could have predicted what would have happened, but here we are 4 months later, and everyone is actually better off. So with that, just thank you for listening, and it was great to be a part of this. I really enjoyed it.
All right. Thank you very much, Marc and Riaan. Well, I think from my side, from an administrator perspective, I would say to my members of the fund that it's important to be educated or to get education in terms of what is happening within the markets and the global space and your investments in general. And I think getting the right information, I should qualify that because there's a lot that is going around. I think as we have heard from the other panelists as well, there's influx of a lot of information. However, I think when it comes to the decisions that you make for your fund, it's quite important to get the right kind of information. And I think we as the fund as well as the administrator, we are here to also inform you or to give you the right kind of information that helps you make the right decisions. And I think as Mabatu has said in the comments section or in the chat that at this time, at these difficult times, the best thing you can do is calm down. Do not panic. Definitely, panic is not important at this time. But also, I think from what I've seen, because our platform also allows people to view their statements as and when, and to see the fluctuations that are happening in their funds, it's important for you to understand why there are fluctuations and to appreciate the reasons behind that and how you recover. Also appreciate the recovery that comes from that. So definitely, I would say the best thing to do now during these tough times is to stay in the market. I know even on our umbrella fund, there's an option to be a deferred member, even if your retirement age is due. You can defer that. There are options in the market also for preservation funds. There's a lot that is available that you just need information on in order not to cash out during this downturn in the market. So definitely no panic. This too shall pass. So definitely let's wait for it to pass, and then I think you will see, and there's always light at the end of the tunnel, so to say. Thank you very much, Natasudi.
Thank you, Sesh. I think it's time. We've come to the end of our webinar. We believe you've learned a lot and you are going to take action. Perhaps even sit back and reflect on your own investments. There's an interesting question in the Q&A that says, how much volatility can I take before I decide to disinvest? But remember, when you disinvest, you are materializing that loss. But of course, remember, it's not about the action during the event, but it's the action that you take at planning stage. Obviously, if you're invested in stocks, the important thing as well is to remember is that there will be volatility. Even if Iran and the US are best friends, there will be downturns, and they should have already understood that from the onset. So that, of course, comes with the good upward trend, which is a good return. So the higher the risk, the higher the reward. So understand your risk tolerance and, of course, your risk and your return appetite even before such events arise. But let me take this opportunity to thank Sesh. Thank you, Lerato and Mokoma. Thank you, Marc. Thank you, Riaan. This has been, we should do this more often. And I think Sesh wanted to beat me to it. But ladies and gentlemen, go take your anxiety medication. do not panic. Thank you. We may leave this session. Thank you.
Thank you.
Thank you.
Thank you, everybody.
Bye.
Bye.